Okay, so this is your first session, XMC members, which is introduction to the market structure that we will be using throughout the course. As I already told you guys, please ask questions related only to the current topic. And yep, my English is not that much perfect, so if I make any mistake, just ignore it. The main focus should be on delivering the actual knowledge. Okay, let's start today's session. So today we are stepping into one of the most critical pillars of trading, which is market structure. Whenever you enter the market, the first thing you must really understand is the authentic structure of price. Most course gurus will teach you basic ideas, which is high highs, high lows, and textbook moves. But today I'm not here to show you what's common, okay? I'm here to reveal what lies beneath the surface. The market doesn't behave cleanly. Sometimes it spikes violently, sometimes it flows with calm precision. And your survival depends on reading both realities. Let me show you now. Normally when we observe the market, we see a simple flow like this. Let me show you. High highs, high low, again high high, pullback, expansion and high, and then again pullback and expansion again. But in the real market, the market never moves in a perfect straight line. It always breathes, impulse, correction and impulse again. And the same goes for the bearish trend, like this. Okay, understand this deeply now. When the market is trending upward, it does not form clean highs and high lows always. Between those moves, you will see fake outs, liquidity hunts, and sometimes even sudden structural shift. If you don't know how to spot these, you will be punished. So now the question is how to identify a real structure. Let's deep dive into it. Let me clean this first and switch it. Okay, so if you look at this diagram carefully, the structure that we see here, we normally see in the market as well. Now, if we divide it, I will divide it into two things. One is our strong lows and other is strong highs. And similarly, you weak highs and weak lows. Okay, so look at this diagram carefully. The structure that we see here, we normally see in the market as well. Now if I divide it, I will divide it into two things. One is our strong highs and strong lows, and similarly our weak highs and weak lows. So first, let's talk about what are strong highs and strong lows. If we talk about strong lows, as you can see in the diagram, any low that breaks the structure after sweeping the liquidity is called a strong low. I repeat, any low that breaks the structure after sweeping the liquidity is called a strong low. Okay. Now if you look at this example, we have this low as a strong low. What is the reason behind this? Because this low has swept the liquidity from this low and then has broken this high, meaning it has broken the structure. So according to the theory, this low is a strong low. Okay, same if we look at the next example, then this low is also a strong low because it has a liquidity sweep from below a low and then it has broken the structure. This will also be called a strong low. And the third example is also very similar, that this is a strong low. The reason is same, that the market has first swept the liquidity from below the market and then it has broken the high end structure. This will also be called a strong low. If we go to the flip side of this graph, we can see that we have a bearish structure in which the market sweeps the high and then break the low. So in this case, the high that will have which has swept the liquidity and moves from there, have broken the structure, we will have a strong high. If we look at the next example, this high has first swept his high and swept the liquidity and then broke the low, which means that this high is a strong high. Now, why we need to identify these highs and strong lows, and what is the actual reason for this? First of all, any structure that breaks like this, there are chances that this is a fake structure. And whatever point of interest we have here, the market will fail. So first of all, we can identify which is the actual structural break and which is not the actual structural break. Plus, we can identify the POIs, point of interest zones, and high quality zones that we have. Similarly, any POI that is formed with a strong low which sweeps liquidity and then form a POI. POI is of a point of interest where we're gonna take entries. Okay. So these POIs has a high chance of working, and that is a high quality zone. In the same way, if we look at the bearish example, that if the market sweeps the high and then breaks the low, in this case, any POI that we have has a high chance of working, and that is high quality zone. So through these strong highs and strong lows, we can have, first of all, we can identify which is your actual structural break and which is not the actual structural break. Okay. Also, we can identify which is your valid zone and which is not, where you want to see the trade and where you don't want to see that trade. And if we talk about weak highs and weak lows, it simply means that if the market is bullish, then the high from which the pullback starts is a weak high, and the market will break it again. Similarly, any high from which the pullback starts after a structural break, which is responsible for the whole pullback, is a weak high. Whenever the markets move towards it, it will break it. But it is important that whenever the market moves towards a weak high or a weak low, it should first create a strong low or a strong high. Suppose if the market is bullish and the pullback has started from here, then this is logically a weak high. If the market wants to break this high, then it should first sweep the low, then break this high, and automatically creates a strong low here. Only a strong low can break a weak high. I repeat, only a strong low can break a weak high. So we can also identify which high is actually liquidity and when it can be our next target. In this case, whatever point of interest we buy from here, here, or here, we can say that the next high is our target. Now, N has to break at the last, so we can hold our position up to there. Okay, so the next thing is the advanced market structure. Now, this is the structure in which two things come together. One is your swing structure and the other is your internal structure. Now, you don't need to get confused about this. There's nothing that will confuse you. Now, simply if we explain this, then here we have a swing structure where we have a major expansion, major pullbacks, and we can see big swings. And in these swings, suppose we have this swing like this. Now in this swing, we get to see an internal structure. Now what happens is that whenever market breaks a high, it does not break through the same move or the same canvas. So what does it do? Of course, is that if there is a high like this, a weak high, and the market pulls back after the liquidity sweep, it will normally break the structure in this case. The structure point we have here is an internal structure, like here. We had the internal structure, these small swings are internal structure. So here too, we have divided the advanced market structure into two categories. One is the swing structure and the other is the internal structure. Now what happens is that when the market breaks a high, suppose the market breaks a high in a swing, after that logically the market has to pull back. And how can we identify that pullback? Normally what we see is that we need an internal structure break, like here. This is an internal high and this is an internal low. This is an internal high and this is an internal low. And this is our swing high and swing low. So in the same way, we also have a internal high and internal lows. Now when the market breaks an internal low, then normally there are chances that the market will now pull back, and after pulling back, the market will again hit a point of interest here. After hitting it, it will start moving in its next direction. But how do we identify that our pullback is over and the point of interest we hit is a valid point of interest from where we can see major moves? First of all, when we have a strong low and a strong high, a swing low and a swing high, it helps us to identify where to buy and where to sell. Like when the market pulls back, it sweeps a liquidity point and makes an internal high break. Just like the internal structure was running, the internal structure was also running during the pullback. So when the market breaks an internal high, our bias simply vanishes to bullish and we get a strong low. After this, we simply buy whatever point of interest we have and target our next week high. So through an internal structure, we know when our pullback has started and when it has ended, when we have a weak high and when we have a strong low. So any low that sweeps liquidity and then breaks the structure, logically we have a strong low. Like this low sweeps liquidity and then breaks the structure, so we had a strong low. But before this swing structure breaks, when the market pulls back and creates an internal structure, the market first breaks that internal structure. So before the actual swing structure breaks, we can identify that now we have an internal structure break. A strong low has been formed, like after this internal structure break, we had a strong low. After this, normally our bias was bullish and we could only see trades of up to this high. In the same way, if we look at this example, we can see that the market has pulled back, sweeps liquidity, and then breaks the internal structure, and the market has started getting bullish. In this case, whatever point of interest we have, we can see the trades of while targeting the next big high. Now, one thing that we see in very rare cases is that our swing structure is also sometimes swept and then reversed. Suppose in this case we had this swing low, this one, and this was a strong low. Now market sweeps it, and after sweeping it will immediately reverse. Now in this case, how will we know that this is just a sweep. This is not a structure break, this is not a structure shift. In that case, as soon as it sweeps, we will immediately see an internal structure break. As soon as we can see the internal structure break, you can easily identify that this was just a liquidity sweep and have a new strong low. And now market will target the next week high. And similarly, if you want to identify when a bearish structure has shifted, that if the market is going bullish, then it has shifted into a bearish structure. Then for that, you need two structure breaks, two consecutive structure breaks in one direction. In case if the market breaks low, pulls back, breaks low again, then we will have two consecutive structure breaks. After this, normally we can shift our bias bullish to bearish. And in this case, we will start getting strong highs and weak lows. And then simply the point of interest will be close to strong highs from where we can see the sell position. Okay. So this was just theory of advanced market structure, basic market structure, strong highs, weak highs, strong lows, weak lows. Now, after this, what we do is we go to the live market and we find many examples of this kind of advanced market structure. Let me shift to the market. If we come here, this is a gold 1 hour chart. First of all, let me tell you all that this same thing works the same way in every time frame. Even you open 1 hour, you open 1 minute, you open 1 week's time frame, you will see the same thing repeatedly in every single time frame. Now, if we see here, here we had a structure break, a swing structure break. Now, why is it a swing structure break and why is it a strong low? First of all, this low has a swept liquidity from here. After sweeping, it broke the internal structure. After breaking the internal structure, what did we have to see? Buy trade from bullish POI. So what did the market do here? After breaking the internal structure, the market continuously went bullish and then the market broke the swing high. In this case, we had a strong low, a swing low, and here a weak low, and here a weak high, a swing high. Now, when the market again broke the internal structure, as we read earlier that the market does not directly break the structure in the same kind of candles. Of course, in this way, swings go in any direction. Here we have multiple internal structure break. All these internal structure break identify that the next liquidity has accumulated under these lows, which will sweep during the pullback market. We will talk about this in detail later. So when we get an internal structure break here, we can identify that a weak high has been created and now the market will pull back. After the market pulls back, it sweeps a major liquidity point into the discount and then we get a internal structure break. After the internal structure break, we simply see the buy trades, and in this case we get multiple buy trades like 1, 2, 3, 4, 5. We will study this in detail later. After the internal structure break, we have a swing high and a swing structure break. This is low and this is high. This is our main swing structure. Okay, so this is a strong low and it has swept liquidity. Then internally it also broke the external structure, the swing structure. So again our bias is bullish as of now regarding the swing structure, but we have to pull back the market as well. And here the pullback happened. After the pullback, what happened? The market swept liquidity, and after the liquidity sweep, the internal structure was broken. Simply after this, your bias was again bullish, and you just saw the pie trade targeting the next week high. The same thing happened. The market continuously mitigated the bullish point of interest and kept going up. Your main liquidity point, which was your main week high, was broken there. And after breaking this high, the market finally stopped here and broke the internal low. And after this break, we got a deeper pullback. During the deeper pullback, there was another liquidity sweep, some mitigation happened, and again we saw the same thing happening repeatedly. Here we had another internal structure break. After the internal structure break, again our bias was bullish. We were just looking for the buy trade targeting the next week high. Here also we got multiple buy trades, and the main swing high, which was a week high, was broken by the market. Okay, so after the break, market stopped here and pulled back. After the pullback, there was a liquidity sweep and mitigation. Then there was an internal structure break. After the internal structure break, you would have seen a buy trade from the bullish point of interest. Finally, you got a good, good move here. Your move was almost 300 to 50 pips. After that, there was a pullback again. Internal structure break happened. Market hit the bearish point of interest continuously and came down. In this case, your swing was low. In this case, your swing was low, and there was a break here. After the break, you got an internal structure break like this. As soon as you got an internal structure break, you would have seen a buy trade from the bullish POI. And similarly, your next target would have been a week high. Similarly, market created a strong low here, and after the liquidity sweep, after the internal structure break, your swing was high. The week high was also broken, and this pattern, this thing will be repeated again and again. You will see this pattern again and again, that the market deeply respects strong lows and strong highs. Market respect any low that has swept the liquidity and then broke the structure. I repeat, market respect the point of interest that is created with it. Whatever we have read about the structure, let's implement it in different time frames and see if those things really works or not. So right now we have a daily time frame, and if you see here, the same thing is being repeated to you as we did earlier. That any structural break is not like this. It is not a valid structural break. What is a valid structural break? That any low which sweeps the liquidity and breaks the high is a strong low, and that is also a valid structural break. And if we see its bearish example like this, then any high which sweeps the liquidity and then breaks the structure with a strong high, and whatever point of interest will be made with it, the chances of it working are of course high. So this is the daily time frame we have right now. And if we see here, the same thing is being repeated as here as well. If a market breaks a high, then before breaking the high, the market sweeps the liquidity from below the lows and then breaks the high. So in this case, the low that will break the high after sweeping the liquidity will be a strong low. Now, in this case, the structure we have is this low and this high. And in between this, we will see the buy trades. Of course, when there is a pullback, we can also see the sell. There is nothing wrong with this. We can also see counter trades, but of course, they are low quality and low probability setup. But any setup that aligns with our high time frame and strong lows or strong highs has a high chance of working. Okay, so this was over low and this was over high and this was over strong low and this was over weak high. So the market broke this high, and after the pullback the market broke this high again, and the same thing repeated. If you look at here, so there was a pullback. What happened before the pullback? Liquidity swept and the market broke this high again. So after this high break, which was already a weak high, which had low chances of working, and it was bound to sweep at the end. So when this break happened, now we have another strong low. It has sweep liquidity and have another strong low. It has sweep liquidity, mitigated, and then broke a high. Okay, so after this break again, our swing structure is from this low to this high, and again after the pullback we will see buy trades. Now the same thing repeated here. The market pulled back here, it swept the internal low. After sweeping, the market again gave us an expansion, and what happened as a result of the expansion? Again our swing high, our weak high was broken and we got a new strong low. So if you look at similar things here, there was an internal break, then a pullback, the market pulled back. So if you look here, we had an internal break. After the internal break, the market, there was a pullback, the market attacked the point of interest, and from there we saw a bullish move. If we look at this expansion, it was almost 160 to 170 pips. Of course, during those days, the market was not making much of a move, which is why our weekly or daily structure was not moving significantly. But if you look at today's situation, the market is very volatile. The market is making very big moves, moving 700 to 800 and even 1000 pips in one direction in a single day. Okay, so when we got a strong low like this, then we got a strong high and the market pulled back. Unfortunately, it was not a deep pullback. There was only a slight pullback here and then we saw an expansion. Okay, so when we got a strong low and then we got a strong high, the market pulled back. Unfortunately, it was not a deeper pullback. There was only a slight pullback and then we saw an expansion. Now, in this structure break, we did not get a deeper pullback, but of course, before the structure break, we got a liquidity sweep here. And then the market broke this high and again we got a strong low. After the structure break, what happened? There was a pullback. Now this type of structure break is not valid for us. We do not consider it a valid structure break or a valid pullback. For the structural break to be valid, it is important that it happens only after a liquidity sweep. So in this case, what happened again? The market swept the liquidity here and then broke this high. Here we got to see a strong low. This was our expansion, which was almost 180 pips, 180 pips. Now here we got a new high. This is our low and this is our high. This is a strong low because it swept the liquidity and then broke the structure through a bullish expansion. After that, we saw pullback. This is our daily time frame, and we can observe the internal structure according to the daily candle. Anyway, after that, there was a pullback. Here, our point of interest got some respect. You could almost say that we got a 70 to 80% reaction from there. But anyway, what happened after that? The market moved further down, and this strong low was swept away. As we discussed earlier, in some cases, it happens that your swings break the low and then again moves in the real direction. And how do we identify that? Again, by an internal structure break. After that, again, we can target the weak high and look for buy trades. And if we really want to see a valid structure break, for that we need two structure breaks consecutively in the same direction, like this. So here, when the market swept this low, liquidity was swept and we saw some mitigation here. After mitigation, of course, we could have taken a buy trade from here as well, according to our plan, according to our confluences, but we will not talk about that now. So what happened here? The internal structure broke, the market pulled back, the market dipped into bullish POIs, and again we saw bullish expansion from there. After that, the market went up by continuously mitigating the bullish POIs, and here we had multiple buy trades because we knew that this was our weak high and we had a strong low, this one. So this is a weak high, the market pulled back, and what happened after that? The market pulled back. If we see here, liquidity was swept, some mitigation happened, and after that the market again gave us bullish expansion and broke this high. After that, the market pulled back and again broke a high, but as we discussed, this is not a valid structure break. This is just a bullish high, a weak high. It's not a valid structure break. This is just a bull trap. You can call it a structure break, but this is not a strong low because there was no liquidity sweep. So this will break, and after breaking, the market will again provide us its real expansion, its real structure. The same thing happened here. The low was swept because there was no liquidity sweep before the high broke. Okay, this is structure. We are in the pullback phase. The market is pulling back, and knew exactly. We knew exactly that the market was going to pull back. How? Of course, we will find out that later. But if we look here, we are seeing very good moves. This is a move of almost 2,470 pips. Yes, and similarly, we had a pullback. This was also almost 2,000 pips. Yes, exactly 2,000 pips. The expansion was about almost 5,000 pips. Similarly, we had good moves, good expansions, and good trades. You can go on any time frame, in any month, in any year. You can go back, look at the recent price action, and you will see the same thing repeating again and again. So, any low that sweeps the liquidity and then breaks the structure is a strong low and has more chances to work. The same thing happened here. It was also a strong low that was respected, and the market gave us this bullish expansion. After that, we got a strong low because it swept the liquidity and then broke the structure. We had a weak high that the market had to break again after the pullback. After the pullback, there was a multiple low sweep. After the sweep, we got an internal structure break. After the internal structure break, we could open multiple buy trades according to our plan or according to our situation and according to the market trend. Similarly, when the market was pulling back, we also had multiple sell trades. This is our daily time frame, like these multiple sell trades, but this is our daily time frame. Of course, I cannot tell you exactly how many trades there were and how many there were not. Similarly, we will go to our main time frames where we have to select the POIs, point of interest, and there we can see how many trades were in the direction of sell and how many in the direction of buy. So you can see the same thing in every time frame. Now we have the same thing in the daily time frame: high sweeps, low break. So you have a swing high and a swing low, and this is a strong high. Similarly, you can see the same thing: liquidity sweep. The high you get is a strong high. Simply the high that sweeps and breaks the low is a strong high. Even here we have the old price action. The same thing has been repeated. This is the 2014 price action. Maybe this is the price action when neither you nor I had even started trading. But even then, the same thing keeps repeating again and again. You can even go further back into old price action. Now this is the 2012 price action when maybe you and I could not even use our mobile phones. But even here, the same thing is repeated again and again. We have a liquidity sweep, we have a break, we have a strong high and a weak low. After the pullback, again, there is a liquidity sweep. The internal structure breaks. There is mitigation of the bearish price, and the market breaks the swing low. And you will keep seeing the same thing again and again: liquidity sweep and next structural break. So anyway, this was our daily time frame, and if we go one step further, if we open the weekly time frame, will we see the same thing there as well or not? Of course, we have our weekly time frame here, and we are seeing the same thing here as well. The only difference is that our pullbacks have shrunk a bit. As you can see here, liquidity was swept, structure was broken. This was a strong low and this was a weak high. There was a pullback. After the pullback, there was a multiple liquidity sweeps, and there was an internal high break, and again there was a bullish expansion. And the weak high that we had, the market broke. The market just broke it. And the same thing has been repeated again and again. If you go back to the previous price action, there is a liquidity sweep, there is a strong low, it breaks the structure, the market pulls back, it mitigates, mitigation, expansion, same thing. Structure break, strong high, mitigation, again drop, liquidity sweep, structure break, strong high, mitigation, again drop, liquidity sweep, strong high, mitigation, drop, repeat. 1 minute. If we go into it, we will keep seeing the same thing happening again and again. Now just shift to the 1 minute time frame. Of course, since this is 1 minute time frame, we will get to see a lot of structures on daily basis. But among these many structures, one thing that we will find out common is strong highs and strong lows, weak highs and weak lows. For example, there is a liquidity sweep here, a structure break, a low and a high. We have a swing low and a swing high, and we have a strong low, which means the chance of point of interest working are high. The market came, the market broke the internal structure after the liquidity sweep. After this, we simply see the buy trade targeting the next high. After that, again, you have a strong low and your weak high came. The market pulled back, broke the internal structure after the liquidity sweep, and again the market broke the weak high. Here, the same thing is repeated again and again. So today we saw what a basic structure is and what an advanced structure is. How we can map our structure through strong lows and strong highs. How we can find buys in a better way, and how we can find high quality sniper entries where we do not see any drawdown at all. We can activate and execute that buy trade. And if you didn't understand something today, rewatch the session, play it while going to sleep, let it sink into your subconscious. Nobody is born with knowledge. You must train your eyes and master the charts through repetition. Over time, with real effort, the next move of the market will start to appear naturally through your sixth sense. Okay? This is how real traders are built. And one last note that earlier I was using my real voice, but now only those who survive till the end and reach the live sessions will hear me directly. Until then, practice hard, stay sharp, and goodbye. See you in the next session.